Hello, everyone. Welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. I'm excited to with this new year, to talk about how the markets performed this last year. We'll start with the slide, the weekly slide, so you can see the picture of the week as we look at this. I don't want to spend a ton of time this morning, but want to share with you a couple of things that's happened. If you remember, 2022 was a very difficult year in the markets. 2023 started out really great. We had a big decline in August, September, and then part of October. But by November and December, equity started doing well again. You can see from this chart that the top performing asset class for the year was the U.S. large cap, followed by developed markets equity. That's international, U.S. small cap, global high yield. Global high yield is basically high risk bonds. Effectively, they work more like stocks. Real estate investment trust, 11.4%, and then emerging markets equity. Closing out the last three are U.S. fixed income and cash. It's been interesting to see how fixed income has performed. Obviously, as interest rates have been risen, fixed income has struggled quite a bit. As we look forward, it appears, once again, we don't know for certain, but it appears the Fed has stopped raising rates. And so while that's happening, we're looking at continued high yields coming from the fixed income side of your portfolio. Now, if the Fed does start to drop those rates, those bonds that are being held in portfolios will continue to earn those higher returns, and we can recognize higher yields by repositioning those bonds into other positions, et cetera, and taking capital gains, et cetera. So there are a lot of things that we can look at as it relates to that. But you can clearly see that 2023 was a great year for equities, anywhere between 10 and 26%. Now, obviously, in your portfolio, we have multiple different asset classes. We're not trying to pick and choose asset classes that are going to perform year by year, but we want to make sure we have good broad diversification to be able to do that. One thing that we generally do not hold a whole lot in portfolios is commodities. There are a few of you out there that may have some commodities. Just generally speaking, commodities are not the best place to hold assets long term. And in a situation as that, you can see from 2023, commodities were not a great place to hold assets. We continue to monitor cash positions. If you have a lot of high cash positions and you're looking for places to store that and get a higher return, we can help you with that. Give us a heads up. We can look at those options. But for the most part, you can see that the 2022 difficulty in the markets have been overcome now by the 2023 return. We don't know really what is in store yet for 2024. We'll keep an eye on what's going on. But one thing we do want to make sure that we always do is stay properly diversified, keep on top of what's going on in the world of finance, and make sure that we're moving in the right direction. Hopefully 2024 will yield a few decreases in the Fed funds rate, and we'll see some decreases in interest rates. I think that'll spur in the economy growth. This is an election year. Politicians love to have good economic growth during election years, so we're hoping that that will continue. As a general rule, you can expect about 2 or 3 negative returns out of every 10 years in the equity markets. We've obviously had one in 2022. It was pretty severe, but we've overcome that now, so we're hoping that 2024 will be a much better year. As usual, feel free to forward this to any friends or family members that you have that may be interested in looking at this. We look forward to meeting with each of you during our reviews this year, and feel free to reach out to our office if you have any questions in the meantime, and we'll see you guys next week. Thanks.